Morning, students. Morning, everyone. In the last class, we were discussing about inventories, and I told you that we'll finish inventories and then move to the other topic, right? So, now, what did we discuss in our previous class? It was all about different methods of valuating the inventory. How do you value inventory using different methods? We have seen historical and non-historical, both the methods, right? In historical, we had the first was specific identification method. This method we have used if suppose the goods, the inventory is not identical, then we have used this method. If the inventory is identical and can be replaced with other inventories, then we can use either FIFO or LIFO, or we can also use weighted average, right? LIFO and weighted average. We also have done the simple average. Almost both works the same, but a little difference is that you take units also into consideration when you're doing the calculation. That's the main difference between simple and weighted average. And FIFO is nothing but first in first out, wherein first purchased goods will be issued first. If in last in first out, which is LIFO, last purchased or the recent purchases will be issued first for production. That's the difference between FIFO and LIFO. And weighted average, we will try to see what is the average price of the goods that we have purchased in different lots altogether, and that is considered for issuing to the production department. And specific identification method was where we used cost or NRV, whichever is lower, right? And other than this, we also had non-historical method. In non-historical method, it was about adjusted selling price. Right. So what was this adjusted selling price? We did one problem on this also, and I asked you to do a homework on this. Did everyone do that? Adjusted selling price. So in this adjusted selling price, it was all about knowing the opening inventory, and then you also know what is the cost of goods sold and everything. Then you derive at what is the closing inventory. And then you calculate what is the closing inventory and find out what is the value of your closing inventory. Also using the gross profit margin. I mean, you might know the sale price of the closing inventory, but how to calculate the cost price of the closing inventory will be calculated using this adjusted selling price method, right? So this was what we have done in the previous class about different valuation methods. And I think I asked you to do this problem. The seventh one, it was almost similar. Seventh one, and also I asked you to do, I think, 11 and 12. 11 and 12. 11th one was about the FIFO method, and 12th one was about the weighted average method. These two are almost the problem that we have done before. I mean, this method we have done, it's a similar one, so I asked you to do it. Hope you all have done that. And last topic that is left in inventories is inventory staking. Okay. Yeah. So now what is this inventory staking and all these things? We'll discuss that first and then move to the problems. If you remember, I told you about the inventory systems, two inventory systems. One is perpetual and the other one is periodic. And I also told you that on a particular date, you will close down your business and start counting your inventory. Inventory is physically counted, is what I told you, if you remember. These are like the inventory systems. But on a particular date, to know your closing inventory, you will have to close down your business and see what is the stock on a physical count basis. To do that, that is called inventory taking. Inventory taking means you physically close down the business and start doing the physical verification of the stock. That is called inventory staking, right? Now, what happens in this inventory staking is either, suppose I'm closing my business on 31st March 2026, okay? And suppose I have, a chance of doing this inventory staking on either 1 week before or 10 days before the year end date. This is your year end date, right? This is your year end date. You can do it either before or after. Both are possible. Which means what? Let us suppose I am doing my inventory physical counting on 25th of March 2026. Possible. Sometimes I do it on 10th April 2026. This is also possible. So either you go that way or this way, or you do it on the year end date also. That is also possible. But sometimes, closing down the business on the year end date might not be possible because you'll have to close down so many things on that day. Closing the entire books of accounts is also done on that day. So physical verification sometimes may not be possible on that particular year end date. So what you do, either you do it before or after, right? So if you're doing before or after, what have to be done is what we are going to learn now. So if you're doing on that date, but on that particular date, on 31st March, you know that the physical count of the stock is, suppose product A, some 150 unit, B, 300 units, C, some, and so on. You know the count of the physical stock and the value also. It is fine. On that date, if you're calculating it, it is fine. No issue at all. No adjustments have to be done. But the problem comes when it is done either before or after. It is why? Because if you're doing before means what? On 25th March, the inventories are calculated. But you will need the inventory count as on 31st March. So what have to be done? The difference between these two, either the purchases that are done during that period or the sales that are done have to be adjusted. Here also it is the same. Any purchases that are done during that period or the sales that are done that period have to be adjusted. Adjusted matlab what you have to do. It is nothing but these purchases, if the evaluation physical count is done before, then these purchases and sales belong to the same year. So they have purchases have to be added, sales will be removed. It will go the opposite. Purchases will be removed, sales will be added. It is why, because these purchases and sales doesn't belong to the current year, because I have done it during that 10 days period after my year end date. These purchases are not my purchases of last year. These sales are not the sales of my current year. So these are for the next year. So purchases have to be removed and sales have to be added back to know the actual physical count of the inventory or the value of the inventory. So this adjustment have to be done if it is done either before or after. If you do this adjustment, then you will exactly know what is the inventory as on your year end date. That's the only thing we will have to do. I think we'll do a problem. Look at this question. Look at this question, everyone. They have given you the following particulars: ascertain the value of inventory as on 31st March 2022, right? Now you will have to calculate the closing inventory or the value of inventory as on which date? 31st March 2022, which is your year end date. But what is the information given to you in the question? Inventory as on 1/4/2021, which means this is your opening inventory. Clear? Because it is the opening date. The inventory as on that date will be your opening inventory. Very good. You have purchases given, manufacturing expenses, selling expenses, admin expenses, financial charges, and sales are also given to you. Okay, good. Now, what else is given? They gave you some adjustment point here. At the time of valuing this inventory as on 31st March 2021, it is not 31st March 2022, it is 31st March 2021, which means previous year, right? So previous year, which means the closing stock of last year or the opening stock of the current year. This is the opening stock of the current year. We have an adjustment to be done. What is that adjustment? They're telling you that a sum of 17,500 was written off on a particular item which was originally purchased for 50,000. So something that was there is a particular item which was purchased for 50,000, 50. and then they have written off 17,500, which means the value now is not 50. It has come down by 17,500. Okay, fine. And what did they do after that? They have sold this particular item in the current year. In the current year, they sold it for 40,000. Fine. Now, bearing this transaction relating to this item, the gross profit earned during the year was 20% on sales. What is the gross profit ratio? Or the percentage? 20% on sales. This is also given to you. Sales is also given to you. So you have opening inventory, you have purchases, you have expenses, and you have your sales and gross profit. So what is the balancing figure? It is nothing but your closing stock. Agreed? Yes or no? Someone has a question. Okay, Gravit has a question. He's asking about the sales returns and purchase returns. Now, when you have, he's asking whether we will have to adjust that also. When I told you you're adjusting purchases and sales, adding or subtracting sales and purchases, same applies to your purchase returns and sales returns also, because they are also part of your inventory, right? So if you have some returns coming up, either purchase returns or sales returns, both the sides, any returns also have to be adjusted. They have to be adjusted. You can't ignore them, right? Because now they are not part of your inventory. Either they are not part of your inventory or they might be part of your inventory. So you will have to adjust them. Don't worry about that. We have a problem which considered returns also. So we'll take up that. Don't worry. Okay. Now in this question, I will simply draw this account once. Trading account. So we have opening stock given in the question. Yes. And then we have purchases also given in the question. And there are few direct expenses given, indirect expenses also given in the question. We will see what to be considered, what not to be considered. And you have sales given in the question. And then you have, do we have closing stock given in the question? We don't have closing stock, right? So this value is there, this value is there, this is there, this is there, but closing stock is missing. And you can also calculate gross profit, because percentage of gross profit is given. You can calculate that also, right? Now, what is the balancing figure now? The balancing figure will nothing but be the closing stock. This is how we are going to do this problem. Like basing on the trading account, whatever we have, if you look at the trading account, these are the main items that you will have to consider: purchases, sales, and then opening stock or any other direct expenses. And then you have your closing stock or gross profit as your balancing figure. Since you know the gross profit, the balancing figure here will be your closing stock. Right? So I'm using this as a base and I will do the problem, but I'll do it in a tabular format. So this is illustration 8. Pratik, you're confused about what? In purchase, sale, adjustment? Don't worry about that, Pratik. I will do a problem. Don't worry about that. You just understand what we are trying to do in the problem. Maybe then you'll be clear. I think since we didn't do the problem, you are, having that vague thing of how to do it and all. But still, once we finish the problem, I think you will be clear. Okay? Don't worry about that. Yes. So like I told you, we are going to do it in a tabular format and not the trading account format, because that is what generally we have to follow for calculating the value of inventory. This we are going to do it as on which date? 31st March 2022. Right? So what is the first item we have? Opening inventory. Inventory as on 1/4/2021. So what is the opening inventory we have in the question? 142,500. Please do it with me so that you'll not be lost. If you don't do it with me, you will be lost. Opening inventory is given in the question. If you can see in the first line, the opening inventory is 142,500, right? We have an adjustment to do for the opening inventory. So we'll do that, then move to the purchases and all other things. So we are going to remove the book value of abnormal inventory. What is the abnormal inventory here? They told that this is written off, right? And the actual purchase value is 50,000. So what is the value that you have to remove? 50,000 minus 17,500. Why are we removing 17,500? Because it was already written off, right? You don't have that value anymore in your books of accounts. Whatever is the value that is existing in your books of accounts, that have to be removed. So it is 50,000 minus 17,500. What is the value? Just check the value. 32,500. Okay. Sarla, you are giving 1,10,000. What is that value? Acha, net. Okay, okay, agreed. So you told me the net value. It is 1,10,000. Got it, got it. So opening inventory may we had a small adjustment. We have removed the book value of abnormal inventory and then only have shown the net figure of 1,10,000. Fine. After opening inventory, we will have to take purchases. So purchases I will take. What is the value of purchases here? The value of purchases given here is 762,500. Okay. Next, we have direct expenses also, few direct expenses also given. Manufacturing expenses. Should manufacturing expenses be taken? Yes or no? Should we take manufacturing expenses? Yes, it is because it is part of your trading account, right? Yes, we will take that. So it is nothing. What is the value? 1,50,000. I'm taking this. Now, what is the next item? Selling expense. Should we take selling expense? Yes or no? Should we take admin, finance, all these three? Should we take all these three? Yes or no? No. Yes. Caller, right? Why I'm not taking these three expenses into this account is it is because these will be part of your P&L statement in your P&L account, because all these are general expenses which are common for all the products. You can't say that it is only for a particular inventory or it is only for you. It is not used in production. Main thing. It is not used in production. Only any production expenditure, direct expenses only have to be included. So these three will not be added to your problem here, right? So we are not going to take all other expenditure, only manufacturing expenses is taken. So manufacturing expenses I have already taken. Right, now this is done. Now in opening inventory, you will add purchases to it and also manufacturing expenses to it. After this, you have to remove cost of goods sold, right? How will we calculate cost of goods sold? Why are we removing abnormal inventory? Many are asking about this. Why are we removing this abnormal inventories? We have discussed this before also. Abnormal inventory will not be a part of your trading account. It is not part of your trading account. It can't sit in your trading account or it can't sit in the direct production expenditure and all. Because it is an abnormal item, it has to go to your P&L statement. Okay. All that has to go to your P&L statement. Anything which is abnormal has to go to your P&L statement. It can't be there in your trading account. It can't be included in calculating your gross profit. That is why we are removing it. I hope I'm clear. So cost of goods sold, mein, you have sales value given. What is the value of sales in the question? 12,45,000. 12,45,000 is the sale value. Okay. But there are few adjustments again to be done to this. Let us go back to the question again. If you see, this part of 50,000 and 17,500 we have adjusted in our opening stock. But they told that this particular item was sold during the year for 45,000, which means this 45,000 is sitting in the sales value of your question. In this question, whatever sales you have, this includes your 45,000 also, which is again removed, right? I will write minus sale of abnormal item, which is 45,000. Right, 45,000 is removed. Why are we removing this? You have removed the cost of that book value of that abnormal item. The sale value of that abnormal item also have to be removed, because these two are not part of your trading account, or they can't be used for calculating your gross profit. Right. Now, sales, what is the sales value after this? I think it is 12 lakh after the abnormal item. Now you will have to remove gross profit from it. What is the gross profit percentage? They told it is 20% on sales, right? So this will be at the rate 20%. So 12 lakh into 20%. How much is this? 2,49,000. Why, Subhash? Why 2,49,000? I think 240. Many are giving 240 as the answer. Quickly check again, ma. Okay. Fine. Maybe it is a error. Just check. 2,40,000 is the right answer. Okay, fine. Now, what is the total cost of goods sold? Final value 12 lakh minus 2,40,000. 9,60,000. Okay. 9,60,000 is the value. Did everyone get 9,60,000? Anyone got a different answer? Okay, 9,60,000. Okay, done. So finally, what is the answer? What is the closing inventory as on your 31st March 2022? 62. Okay, 62,500. We'll show this together. So we have taken opening inventory, we have added purchases to it, and then direct expenses to it, and then removed cost of goods sold. How did we calculate cost of goods sold? It is sales minus gross profit. Then you get your closing inventory. This example is done using this as a base. You can remember, you know this, everybody knows this trading account. That is why I've taken this as a base and have done this. Okay. You can write this also. Opening stock, purchases, expenses, gross profit, and then sales, closing stock will be on the other side. Done. Did everyone get 62,500? In this question, only adjustment that we have done is about the abnormal inventory. Why are we removing it? That should be clear to you. Why are we removing abnormal inventory? Just because it should not be part of your calculation of your gross profit. Okay, I'll move on to the next question. Illustration 9. Now look at this question.
Hello.
Yes, sir, Latin.
Just tell me now, ma'am, how this profit and on sale of abnormal loss later, where it will be shown in.
In your P&L statement, when you're doing your P&L account, you will have to show your abnormal items over there in the end. When you're doing all your expenditure, like you take your selling expenditure, you take your finance cost, whatever other expenditures you have selling and distribution, you will include your abnormal, losses or any abnormal sales that you have in there. Abnormal sales comes on the credit side of your P&L statement, and the book value comes on the debit side of your P&L statement.
Okay, thank you.
Okay. Yeah. Now look at this question. This is also almost the same kind of a question, but the inventory taking is actually done on a different date. So how do you do the adjustments is what we are going to learn in this question. Okay. So trader has prepared his accounts on 31st March each year. So his year end date is 31st March. That is clear. Due to some unavoidable reasons, no stock taking could be possible till 15th April, which means he has closed his books of accounts on 31st March 2022, but he could not do the stock taking, which means stock taking. I hope I'm clear what is stock taking. We're nothing but doing the physical count of the stock, right? So he could not do it till 15th April, which means after closing down your business, your books of accounts are closed on 31st March, you took 15 days to do the stock taking. So when did you do the stock taking, or when did you do the physical count? 15th April. Okay, that is done. On which date total cost of goods in his godown came to 50,000. So on that particular date, he is having the value as 50,000. And he has given you few facts also. The following facts were established between 31st March to 15th April. Why are we given this information for those 15 days? It is because we actually need the closing stock as on 31st March. But we don't know what is the value of closing stock on 31st March. We only know it as on 15th April. So the between 15 days ka purchases, sales, returns, or anything else have to be added or subtracted. We'll see how what to add and what to subtract. So once you do all that adjustments, then you will come to know what is the closing stock as on the year-end date, which is your 31st March. It's like, working backwards. Only on 15th April. So you work backwards and then you calculate what is the closing stock as on 31st March 2022. Right. So what is the information that is given to you? You have sales given. Sales is 41,000. They told it includes cash sales also. It is fine. Whether it is a cash sale or a credit sale, anything it is a sale. So both have to be considered. There is no discrimination between cash and credit sales, because both are sales, both have gone out of your organization, right? When you made a sale, inventory has gone out of your organization. So whether it is cash or credit, both have to be considered. Same applies to purchases also. Cash or credit, both have to be considered. You have a sale return also given. You don't have purchase return, I think. Only sales return is given to you. Okay. And then look at this point. I think these two are like the main things in this question. So on 15th March, what happened? Goods of the sale value 10,000 were sent on sale or return basis to a customer. The period of approval being 4 weeks. So what is this, sale or return basis, and then approval and all those things? I'll tell you how it actually works. Then we will discuss about this point. There will sometimes, if you're launching a new product, or you have made some new thing, you have created some new thing, and you want people to just test that product, or you want to give it like a free, not a freebie, but you tell your customer that I'll give you the goods, you use those goods, or at least you do on a trial basis the goods. If you are liking that good, or if you are okay with that particular item, the inventory, you can treat it as a acceptance, and then you will treat it as a sale. If not, he will return it back to you. So once the approval comes, only then you will know whether it is a sale or not. Until then, it is just a good that is sent to the customer, and you're waiting for his approval. So that kind of an approval is given here for 4 weeks. So the today you sold it to him. On 15th March you sold. 15th March means it is before the year-end date. So before the year-end date itself, you sold the goods, and you gave 4 weeks time, which means almost 1 month time is given to him. Which means you will only know whether he is accepting the goods or returning back to you on 15th of April, around 15th of April. Correct. Now, what is the value that you have sent to them? 10,000. But what happened? He returned 40% of the goods on 10th April, approving the rest, which means 40% of the goods he has returned back to you, which means 60% is the sale value here, right? So 40% came back to you in the form of your goods. But what happened to the 60%? He told that he will accept those goods, so which means it is considered as a sale. Done. We are done with that. And the customer was billed on 16th April. It is fine. Now, when you are actually doing the physical counting, what happened? Do we have that 40% of the goods with us? Yes. Because the customer returned on 10th April, when you have actually done the physical count, you have that 40% of the goods left with you only, are with you only. right? So they're included in the physical counting, so no issue. Now look at the next point. What is happening here? The trader has also received goods costing 8,000 in March. This is for a sale on consignment basis. And what is a consignment basis? You'll have two persons in consignment. One is the consigner and one other one is the consignee. So consigner means, well, suppose I am a person who is manufacturing the goods. Now I will send goods to you. Okay. I am not selling to you. I told you that on behalf of me, I'm not able to reach out to many customers. So better you reach out to the customers and sell my goods is what is your task. Okay, right? So I am called consigner, you are called consignee. What is your task now? To sell those goods to the customers. Directly you are selling to the customers. Am I selling to the customers? No, right? I will only give it to you. So you are like my agent only here. You will just act as an agent. Are those your goods? Are you the owner of those goods? No, definitely not. You are not the owner of the goods. You are just a holder of those goods so that you can sell it to the customers as and when required. But who is the final owner? I am the final owner of the goods. This part should be clear. In consignment, consigner will be the owner of the goods, not the consignee, which means I am the owner of the goods. So I will have hold on those goods, or I will have the right on those goods. You will just have a right to resell them. That's it. You are holding it for a period of 1 month or 2 months or whatever period it is. You just have a right to sell it and give that money back to me, maybe charging a commission on it. That's it. Right? Now, in March, we have received goods of worth of 8,000 for consignment. What happened to these goods now? 20% of the goods were sold by 31st March. So by 31st March, you already sold 20%. And another 50% was sold by 15th April, which means 20 plus 50, 70% of the goods were sold. Agreed? 70% of the goods were sold by 15th April, which is nothing but the date on which you have done the stock taking. On the date of stock taking, when you're doing the physical count, do you have that 70% of the goods with you? No, because you have sold them. Now, what about that 30%? 30% of the stock are left with you, right? Those are left with you. So when you're doing the physical count, these 30% of the stock out 8,000 into 30% of the stock is only left with you. That have to be removed. Why are we removing it? Because it is not my stock. It is my consigner stock. I am just a consignee. I'm just holding them, but it is not my stock. So these have to be removed. And the last point is these sales are not included in your above sales. Should we include them? We should not include them. They have done it correctly only. They didn't include. They're right in doing that because it is not our sales. We only charge a commission. We don't have to record the entire sales on it. Those sales will be the consigner sales and not my sales. So this point they have done correctly. And what else is given? Goods are sold by the trader at a profit of 20% on sales. Okay. You are required to ascertain the value of inventory as on 31st March 2022, which is nothing but your closing inventory. Let us do this. This illustration mine. It's 31st March 2022. Yeah. So what is the first item that we have to take? Our base here to start with is the stock taking ka value. Whatever stock taking we have done, I mean, whatever date we have done the stock taking, that will be my base. And then I will start from there, adding and subtracting few items to calculate what is the inventory as on the 31st March. So what is the inventory? As on 15th April. I'm taking 15th April as my base. 2022. Just 20, yeah, 2022. So this will be my base for sure because I have to start from somewhere. No, where will I start from? I'll start from the stock taking a value. Okay, what is the value? 50,000. Yes. Now I will have to take all the adjustments one by one. Let us look at the adjustments now. They gave sales and sales returns also. Both together we will consider. So you will add or subtract sales here. You will add or subtract sales. Answer, add or subtract. Add. Okay, some are saying subtract. Why subtract? Why subtract? Why do we have to subtract this? Okay. I'll just give you a timeline maybe. This is 31st March. Since you are saying subtract, I'm confused now. Maybe you didn't understand it. Okay. So this is the timeline, let us assume. I'm just trying to tell you in a different way. Now, I know that on this date, it is 50,000. Okay. I don't know what is the value of inventory as on this date. This is what is required for me. So which means I have to go back. I have to go back, right? On these particular dates, what happened? There are few purchases and few sales also. Now, if I have to go back, I will have to add or subtract my sales. Sales have to be added back or subtracted. They have to be added back. Why? Because this stock, as on 31st March, was the only requirement for us, right? Now, out of this stock, they made a sale. And then they have calculated this 50,000. Now, only if I add back this value, I will know what was the stock available as on this date, right? And if I remove these purchases only, I will know what was the stock available on this year end date. That is why we will have to add sales and subtract your purchases. Also, maybe I'll try to give you the other way also. Suppose I have 100 units. When I did the physical counting, I know that there are 100 units. And sales were 10. Purchases were some 20. Okay. During this 15 days, sales were 10 and purchases were 20. So what must have been the stock as on 31st March now? On 31st March, the stock must have been 100 plus 10 minus 20. Agreed? This is how much? 90. So which means on 31st March, the stock must have been 90 units. That is why once I made a purchase of 20, it came down to 110. Then when I made a sale of 100, it came down to 100 units on 15th April. Now, if you are doing this in the 15 days period, it is not your it is not your stock for the last year. That is why they have to be added or subtracted to do the adjustment part. Now, are you clear? Because few people told subtract and all, I'm confused. You're not clear with the concept. That's why I told you in a different way. Hope now you understood. Maybe you can take this example so that it is more clear. Right. Okay. Fine. Yes. So what are we adding now? We will have to add sales. So cost of sales have to be added back, right? Now, what is the sales value that you have? Sales is 41,000. I'm also considering the sales return. Let us do both of them together. So 41,000 minus 40,000. Sorry, 1,000, I think. What is the gross profit? Gross profit, they told it is 20% on sales, right? So here I'm going to take 40,000 and 20% on 40,000 is how much? 8,000. Oh. This is how much? The total is how much? 32. Okay. 32,000. Yes, you're right. 32,000. Now, I also have purchases. Let me take that. Less purchases. Do we have any adjustment to the purchases? I'll also mention the date if you want. 31st March 2022 to 15th April 2022. So this cost of sales that we are adding back are from the dates 31st March 2022 to 15th April 2022. The 15 days ka sales only we added back. Same way purchases also you will have to add it back from 31st March 2022 to 15th April 2022. Right? So do we have any adjustments? No, I think we don't have any purchase returns. The value is directly given to us 5034. So I'm taking 5034 directly. This is 5034. This has to be removed. Okay, we are done. So let's go back to the question again. First point, sales is done. Second point, purchases is done. Sales return, third point is also done because we have taken that in the sales itself. Now the fourth point, which is talking about that 10,000 ka value, which is like sale or return basis. Let us take that also. Add cost of sale, which is sale or return basis. It is not that particular 15 days ka sale. This is a little different, which is sale or return basis, right? Now, what is the sale value here? It is only 10,000 into 60%. I'm only taking 60%. Why only 60%? It is because he has returned 40% of the goods and accepted only the remaining, which is 40%. 60% was accepted, 40% was returned. So only the sale here is only 60%. Then gross profit on this. This is again at rate 20%. So 10,000 into 60% is how much? 6,000. And 20% on 6,000 is how much? 12. Okay. And then final figure. 4,800. Okay. This is done. Did you all finish this? What happened to that 40%? What happened to the 40% of the goods? 40% are returned back to you, which means when you're doing the physical count on 15th April, those 40% of the goods are sitting in your inventory only. Don't worry about that 40% of the goods because they are returned to you on 10th April, which means you have done your stock taking on 15th April. Before your stock taking itself, you got those goods back. So no worries. No, when you're doing the physical count, they were there with you. It is not a sale. So it has to be included in your closing stock. It is included. So don't worry about that 40%. But what we are worried about is 60% because 60% is now a sale, right? So that we have added back because it is built On 16th April, we will have to add back that. This is done. Now the fifth point. Now, what is the fifth point? This is talking about the consignment, right? Now, I told you that the consignment goods are not our goods. So, any unsold stock on consignment have to be removed. Why are we removing? Because it is not our stock. It is not our stock. It is the consigner stock. So, it is not sold means that stock is lying with you when you're counting, but which is not your stock, right? So, it has to be removed from the counter. Right? So what is the unsold stock here? 20% of the goods are sold. 50% is also sold, which means 30% is only unsold. 8,000 into 30% only is unsold, not the entire 8,000 is unsold, only 30% is unsold. Agreed, everyone? Why only 30% of 8,000? 2,400, okay. This also have to be removed, right? Now calculate the final. That's it, I think. We have taken this gross profit percentage, rest all are there. Just calculate what is the. Yes, because they are left in our inventory only, we are removing it. Because they are not our inventory. They are someone else's inventory, we have to remove. Inventory as on 31st March 2022. हमारा स्टॉक नहीं है ना, इसलिए अनसोल्ड इन्वेंट्री को हम रिमूव करेंगे. और परचेसेस और सेल्स भी लास्ट ईयर का नहीं है, इसलिए हम ऐड और सब्ट्रैक्ट कर रहे हैं. इस ईयर का सेल को हम इंक्लूड करना है, पर नेक्स्ट ईयर का सेल हम नहीं इंक्लूड कर सकते ना, इसलिए इसको ऐड बैक कर दिया. दिस पॉइंट, इफ यू सी दिस पॉइंट, व्हाई आर वी एडिंग बैक? इट इज बिकॉज इट इज नेक्स्ट ईयर का सेल. नेक्स्ट ईयर का सेल है वो, लास्ट ईयर का सेल नहीं है, इसलिए हम ऐड बैक कर दिया. सेल्स परचेसेस भी वैसे ही है, वो नेक्स्ट ईयर का परचेसेस है, हम नहीं इंक्लूड कर सकते लास्ट ईयर में, इसलिए इसको रिमूव कर दिया. और ये क्या है? ये सेल और रिटर्न बेसिस में है ना, इसलिए इसको भी ऐड बैक कर दिया, क्योंकि वो सेल हमारा 16 अप्रैल को हुआ है, वो नेक्स्ट ईयर का सेल है, इसलिए इसको भी ऐड बैक कर देंगे. और ये अनसोल्ड स्टॉक भी हमारा नहीं है, हमारा कंसाइनर का है, इसलिए इसको भी रिमूव कर दिया. खाली एडजस्टमेंट्स करना है हमको, क्योंकि हमारे पास इन्वेंट्री किस डेट का है? 15 अप्रैल का है, बट हमको क्या चाहिए? 31 मार्च का कितना इन्वेंट्री है वो चाहिए, इसलिए वी आर doing some additions and subtractions or some adjustments. What's the final answer? 7, 9. 7, 7, 9, 3, 6. Antra Pandey is asking, don't we include the complete cost of goods sent on approval basis, because we still I hope I cleared that question. We are not including the entire if you see this part, sale or return basis, entire 10,000 should not be removed. Why? Because 10,000 is not a sale, only 60% is sale, 40% is there in your closing stock. It is included in your closing stock because it is not a sale. Once the person is returning back to you, means it is not a sale to you. If the person is accepting, means it is a sale. He is returning back to you, means it is included in your stock. When it is included in your stock, don't worry about it. But if in the question they told you that it was not included in the stock, then we will have to do an adjustment. Otherwise, it is fine. Add, subtract. I mean, Pratik, can you be a little more clear of what is your confusion? Why add and all? I clearly told for each point, but still you're confused somewhere. Tell me clearly your question. No, you can unmute yourself and ask if you want, Pratik. Oh, Sarla is raising her hand. Yes, Sarla.
Ma'am, my question is, like we're taking the inventories, we're considering the inventories. One is our
Uh,
own inventory, our own
which one?
inventory,
You're talking about which one, ma?
closing inventory. I'm general
Okay.
questions on the closing inventory.
Okay.
Normally, what happens, we have an inventory of closing inventory of our own inventory. And the second thing is the consignment inventory, which is not ours. We have taken
Yes.
on the return sale and return basis. The
Right.
thing is whether they are going to show separate, like in our own closing inventory and consignment inventory. Or
They will
together.
show. They will show separately only consignment inventory. You will have
When
to
they show
separate,
separately,
maintain
what
the stock,
what is
saying
like,
that if suppose you have different products. Okay, product A, B, and C and D. Suppose you have this product C is not yours. If it is someone else, this has to be maintained separately. The record of product C have to be maintained separately. Or if you have two products, so B and C have to be maintained separately, saying that this was suppose 100 units were received from consigner, 200 were received from consigner. I sold some 50. Here I sold some 20. So that record have to be separately maintained. Otherwise, you will get confused. No? If you mix it with your own inventory, you will not know how many goods of the consigner were sold. So these have to be separately shown, and your stock is also separately shown. But what happens when you're doing the inventory taking? The person, when you're doing his physical counting, he will just physically count. No, A kitna hai, B kitna hai, C kitna hai. He will just count. He don't know whether it is your stock or someone else's stock. So he will just give you a report that product A ka itna hai, product B ka itna hai, C ka itna hai. But product B and C are not yours. You know that, right? So when you're doing the inventory taking, you will only know the count and the value, but it is yours or not, you will have to decide and then add back or remove it accordingly in your adjustments.
okay, thank you, ma'am.
Yeah, yeah.
Yes.
Pratik, you want to ask? Because I'm not clear what you're asking. If you want to unmute yourself and ask, you can. Or else I'll continue. That's right. Going back. Yes, you're right, Pratik. That is correct. Since we're going back, we don't know the stock as on 15th April. We will have to calculate the stock as on 31st March. But we don't know what is the value on 31st March. We only know it on 15th April. So you're going back. Going back, matlab you have to add your sales. Why are we adding sales? Because they are not your sales, no? And then why are we removing purchases? Because they are not your purchase. Not yours, matlab उस year का नहीं है, राइट? वो लास्ट ईयर का 31 मार्च इज लास्ट ईयर, नो? उसका हमारा क्लोजिंग इन्वेंट्री चाहिए हमको. बट ये परचेसेस और सेल्स जो हुआ 15 डेज में, वो लास्ट ईयर का नहीं है, वो करंट ईयर का है, जो नेक्स्ट ईयर में इंक्लूड करना है. इसलिए यू आर adding back sales and removing purchases, and vice versa, right? I hope I'm clear. There's one more last question. We'll finish that so that inventories will be done. Unsold stock is nothing but, if it is unsold, means it is not only unsold stock of your stock, it is unsold stock of your consigner. Okay, you have some 8,000 goods received from a particular person. Are they your stock? No. I told you what is a consigner and consignee, right? So that is your consigner stock, not your stock. You will have to just sell them. Did you sell entire 8,000? No. 8,000 was entirely not sold to customers. Only 70% was sold to the customer, 30% is still with you in your stock. Correct? But is it your stock? Unsold matlab it is not sold to the customers. But can we can we include it in our stock? It is not our stock, no? It is someone else's stock. That is why we are removing it. Since it is consignment, we are removing it. It is not because it is unsold we are removing. It is because it is consignment stock we are removing it, because it is not our stock, which is added to our stock when doing the physical counting. So we have to remove it. Advertisement expenses will not be taken because it is part of your P&L statement. Advertisement, selling and distribution, finance cost, all these are your P&L expenditure items and not your trading account. There's one last question. This is also almost the same kind of a question. We'll quickly do this and then close this inventory chapter and move to depreciation, right? Yeah, quickly look at this. What is the year end date here? 31st March 2022, correct? Reshma, packing and transportation charges will be taken because they are part of your manufacturing expense. You have to pack and transport them and bring it to your location. Those are needed for your product to be used into your production. But if it is a transportation and packing charges for your customer, right, you'll have to pack and transport to your customer, then it is not taken to your trading account. It will come under your P&L statement only. What is the purpose is more important. Advertisement, selling, all these are when after production is done only you incur those expenditure. No, something that is incurred after your production is done, your product is ready, then it is not under your trading account. In trading account, you will only have to take those expenditures which are required for your product to be manufactured. Okay. The transportation and packing charges, if it is from the supplier, I mean, you have purchased it at your supplier and then you have to bring it to your location, then that is needed, without which you can't use the product. That will be added in your trading account. But something which you are doing for your customer, you can't add it in your trading account. It goes to your P&L statement. So what is going to your P&L statement is basically the expenditure which is after your production. During your production, for bringing your product for usage and all that, it is trading account. I hope now you're clear. Yes, this is again a simple question. Let's quickly do this. In this question, the year-end date is 31st March 2022. But when did we do the inventory taking? 10th April, which is after 10 days. Okay. And valuation of which showed an inventory figure of 16,75,000, right? So on 10th April, when you have valued the inventory, physically counted the inventory, the value is 16,75,000. Okay, good. After the end of the accounting year until the date of completion of inventory taking, sales for the next year, they clearly mentioned sales for the next year, which means in that 10 days, from 1st April to 10th April, the sales were 68,750. Okay. And profit margin is 33.33% on cost. Okay, I have to tell you one thing. Since this point came up, I'll tell you. You can remember this table. This is like the easier way to remember. 33% means what? 33.33% means I can say it is one third. Agreed? 33.33% means one third. 25% means it is one fourth. Or 20% means it is 1/5. This everybody knows almost. Like when someone says 33% means it is one third. 25% means one fourth and 20% means one fifth. Suppose they told you that in this question, what is given? If you see, they told 33% on cost, right? If you have to convert it on sales, then there's an easy way of doing it. Suppose this is on cost, okay? Then what will be on sales? This table you can remember. If it is told that it is one third on cost, means it is one fourth on sales. This is one fifth on sales. This is one sixth on sales. Suppose they told 1/2, which means 50%. 50% is 1/2, no? Then this will be one third on sales. You can have this table with you. This will be useful not just in this chapter, in other chapters also. When something is told in cost, then if you have to convert it into sales, then use this. If something is given in sales or you have to do it in cost, you can use this. I want you all to write down this table so that it will be easy for you. Something is on cost or sales or cost, you can convert them easily. How this will apply, we'll see, but just note down this table. Yeah. So what else is given? They have given you the sales for that particular 10 days, which is after your year end, and purchases for the next year also has been given to you, which is 90,000 less trade discount of 10%. Okay. So cost is 90 and they gave you a discount of 10%, trade discount of 10%. Fine. During this period, goods were added to inventory at a markup price of 3,000 in respect of sales returns. So there is a sales returns also in this question. Fine. Now, after inventory taking, it was found that there were a certain very slow moving item costing 11,250, right? So when the inventory taking was done, then they came to know that there are some slow moving goods, and the cost of these goods are 11,250, but they have to be considered now at 5,250 to ensure the disposal to an interested customer, which means you are having a loss here, right? The cost of those goods is 11,250, but now it is only considered at 5,250, right? So you have a loss here. This has to be considered when you're doing the adjustment. The next point says, due to heavy flood, certain goods costing 15,500 were received from the supplier beyond the delivery date of customer. As a result, the customer refused to take delivery and net realizable value was estimated to be 12,500. So what happened here? You have ordered from a supplier, and then due to heavy flood, the supplier could not give you on time, and you could not deliver it to the customer on time. So now the customer is refusing the delivery, and he's saying that I cannot accept this delivery, but the goods can be realized at which value? 12,500. How much was the cost you paid? 15,500. But he's saying that I will only pay you 12,500. So you again have a loss of 3,000 here, right? Here, one loss it is due to slow moving item, and here it is due to the delay of a supplier. You have a loss again here on 31st March. Now they're asking you to compute the entry as on the year end date. Let's start doing this. Slow moving goods means there will, suppose you have manufactured few goods, you have some product that is manufactured. It was a very good product, suppose, and after a few days what happened is the demand for that product came down. The product, the technology has changed. Now I'll give you a best example. Do you buy an iPhone 4 or 5 now? Do anyone go back to iPhone 4 and 5 buy them right now? Nobody will buy, right? कोई जाके अभी iPhone 4 या 5 या कुछ older version of the iPhones do you purchase? Definitely not. Right now, when iPhone 16, 17 is going on, nobody wants to buy the older version. So they will become slow moving goods now. Now, if suppose I have a stock of some 1,000 units of iPhone 4, do you think they will go like hot cakes, that every day I can sell 1,000 units of iPhone 4? It is not possible, right? Because it has become obsolete, or the technology has changed. They will become slow moving. Okay. Let's finish this also. Registration, I think it is 10, no? Registration 10. You have inventory as on 10th April 2022. So I'll have to take that. What is the inventory as on 10th April? 16,75,000. Some additions and subtractions have to be done to this, so that we know what is the actual value as of actual inventory value as on 31st March, right? Now, what is the first adjustment that we have? You will have to see the sales and purchases and all other things. Same thing how we have done the previous question. We'll do it in the same way. So add back cost of goods sold. Sale and gross profit. What is the sale value? What is the sale value? They told sale is 68,750. I'm also considering the returns also here. What are the returns that we have? They gave you sales returns also in the question. Just 3,000. Can you see this? I'm taking both of them together. Sales and sales returns can be taken together. So it is 68,750 minus 3,000. Why minus 3,000? Because these are sales returns, right? I'm taking them together. We can take them together. And gross profit is how much? They told 33% on cost. Now, according to the table that I have given you, if it is 33% on cost, it will become how much on sales value? Because we know only sales value. It is how much on sales value? 25%. Or you can say 1/4. Because 1/3 on sales will be 1/4 on cost. That is why I've given you this table. Okay. They gave you 33% on cost. 33% on cost. So it will be 1/4 on sales. 1/4 means 25% on sales. Let us do this. So how much is the value? Calculate this also. This will be 65,750 minus gross profit. How much? 17,190. Okay. I want the net figure also. Net figure of cost of goods sold. 49313. Okay. 49313. I think Pratik is giving a different answer. 16437. Which one is right? 17190 is right or 16437 is right? Which one is right? I want you all to 1643 is right. Okay, okay, I'll change it. Okay, got it. So it is 16437. Fine. That is how you got 49313. I did then 49313 is correct then? Take it, Pratik. I just rounded it off. It's okay, no problem. You can round it off. If you take 8, I think here it will be 2. That's it. No, don't worry about decimals. So this sales is from 31st March 2002 to 10th April 2022. Okay. Same way purchase is also 31st March 2022 to 10th April 2022. Done. So what are the purchases that we have? Going back to the question. It is 90,000. Do we have any purchase returns given in the question? No, but we have trade discount given. So purchases is 90,000 minus trade discount at the rate 10%, which means 9,000. So this will be 81,000. Right? 81,000. The purchases is also done. Right? Next item is what? Sales returns we have considered. Next we have slow moving goods. Right? So less loss on slow moving goods. How much is the loss on slow moving goods? They told 11,250 is the cost, and then it should be taken at 5,250. So it is 11,250 minus 5,250. How much is the loss we have? 6,000. Fine. This is removed. 81,000 also have to be removed. Okay. Yes, 6,000 is the right answer. Right. Then next point is what? Next we have the delay in goods, right? There was a delay in goods due to some flood. Because of that, you have a reduction in the value. Realizable value has come down. So here you have a loss of how much? It was actually for 15,500. but now you can only get 12,500 out of it. So 3,000 is the loss you have here. Yes, 3,000 is the loss. So what is the inventory? March 2022. What is the inventory as on 31st March 2022? I'm zooming it out. So we have taken inventory as on 10th April, then we have added the sales for that 10 days, which are the sales of the next year. Then we have removed purchases of the next year, and then slow moving goods and loss due to delay losses also we have adjusted. So 1634310. Hope this is the right answer. Did everyone get that? 1634310. How did you get 0 in the end? I think we have some 3 here, no? We got 3 here. So I think you rounded it off. Fine, fine. Did everyone finish? Inventory as on 31st March 2022. Yeah, removing these losses because these losses have to be shown in your P&L statement. I've mentioned this before also. Anything which is like abnormal cannot be added to your trading account or cannot be included. While, yeah, Pratik, you're right. This can be 3 only. I think they have a few people have rounded it off. That is why we got 0, but it can be 3 also because we have 3 here in the sales. So you should get 3 only. Yeah, you're right. So these losses are like abnormal losses which cannot be taken in your trading accounts. I'm removing it here so that I can show it later somewhere in my P&L statement, but cannot be included while calculating my inventory. Okay. Okay, few people might ask the solution here is different. Your final answer is same, no? Solution might be different. It is because the returns, sales returns, they have taken separately, and I have combined it with the sales only. So that's one difference you might notice. And also clearly, I have shown how purchases and trade discount. This calculations I have shown it a little bit clearly. Yeah, they have directly taken the value of 81. If you see 81,000 is taken, right? And then cost of goods sold also they wrote it directly. How you remove gross profit and all I clearly showed so that you understand how to do it. That's it. It's more in a clearer version. I have given a clear version. It is fine. You can directly write it also, but how you have to do and how you are doing it later, when you once you read it again, you should know how you have taken these values, right? That's why I've given it in a clear format. That's it. Any other question on this? Final answer is the same, no? And answer did not change, no? 3 is fine, I think, because you have rounded it off. There's a difference, I think, but so finally, inventories chapter may we have these 11 and 2. I asked you to do it, so we are done with the illustration. So this chapter was completely about what are inventory, what is an inventory, or how inventory works, or different valuation methods, and when inventory staking is done, how the adjustments have to be done. That is what we have studied in this inventories chapter. Rashi, you have a question? Yes, Rashi.
Yes, ma'am.
Tell me.
Ma'am, illustration 9, the point 4, it is a bit confusing. Can you please explain it
Illustration
once more?
9. Illustration
Yes,
9.
ma'am.
Which one? Fourth one?
Yes, ma'am. Point 4.
Okay. In this fourth point, what happened is 10,000 goods you sold to one person. Okay. But you have sold it in with a condition that that person can accept the goods or he can return it back to you. Okay. If that person is liking those goods, he is accepting, you will bill him. You will start invoicing him. If that person did not like those goods, he will return it back to you and they will be part of your stock. Okay, that's the sale and return basis idea basically. So you sold how much? I have given to you 10,000. Okay, suppose you are a person who is purchasing. I gave you 10,000. What did you do after some 1 month? You sent 40% back to me, which means you sent back 4,000 worth of goods. Which means how much did you keep it with you? 6,000. Now that 6,000 is a sale to me. Agreed? Now, what happened to this 40,000, 4,000 are with me in my stock. Since you sent those goods back to me, they are sitting in my stock. I'm fine, no? If they're with my stock, it is not a sale. It is in my stock, so it is good. That is why I didn't do any adjustment for 40%. But for 60%, you didn't return back to me. You are assuming that it is a sale. When it is a sale, I will have to do that adjustment because that sale was billed on 16th April, which was next year, right? That is why I'm adding back to my adjustments here. I have added back, if you have seen, I've added back as an adjustment because it is next year का sale. इस year का sale नहीं है, last year का sale ये नहीं है, next year का sale है, इसलिए you have added back that 6,000 only. I mean, only that 60% you added back. 40,000, 40% or 4,000 is anyway in your stock. Now you're clear. Um, Loss due to delay. Reshma, what is your question? Loss due to delay. Like I told you, loss due to delay or any loss, any abnormal loss cannot be taken while calculating your inventories because they cannot form part of your stock valuation. They will have to be part of your P&L statement only. Any loss, it might be due to slow moving or any delay, they will become part of your P&L statement, right? Abnormal losses they are, not just the normal loss, they are abnormal losses. That is why we are removing here. Clear? So inventories we finished. We have to start depreciation and amortization. Just quickly take 5 minutes break and come back faster. So we'll start this depreciation and amortization. Fine? Yeah, Manish, we'll take a break, 5 minutes break.
Yeah, ma'am. Please continue.
Okay. So now we are going to start the new chapter, which is depreciation and amortization, right? So two different things here, depreciation and amortization. When will you call it as depreciation? When will you call it as amortization? Let's see that. Now, so we all know about assets, right? Assets can be of two types. One is tangible assets and intangible assets. What are tangible assets? Anyone? What are tangible assets? Reshma, I think I'll take your question in the end. Maybe we can discuss this. Since you didn't understand, I'll discuss this with you separately because I don't want to, still continue that inventory thing. Okay. Let us move to this chapter. Any questions we'll see in the end. Okay. So what are tangible assets? Okay. If you are saying it can be touched, okay. Physical existence, very good. Which means physical existence is the main thing in tangible assets, correct? Here, no physical substance. That is for sure. Which means you can't touch this asset, right? If it is an intangible asset, you can't feel or touch it. But if it is a tangible asset, you can have that feeling of touching it and all those things. Any examples? Example? Building. When you call it as tangible, building is the best example. Furniture, right? Machinery, very good. Okay. You're saying machinery. Okay. And what are examples here in intangible asset? Intangible asset. Okay. Goodwill. Very good. Goodwill and patent. Okay. Trademark. Very good. Loyalty. Okay. Copyrights. Okay. Very good. So you all have an idea. What are the examples of tangible and intangible? Tangible assets mean something that is visible to you, or that is something that you can feel physical existence. But when it is an intangible asset, there is no physical substance, there is no physical existence of that particular asset. There are many examples. Yes, you all are right with the examples. Now, this is also having useful life more than 1 year. You use this asset for more than 1 year. This also we use it for more than 1 year. Definitely. Right? That is why these are called non-current assets also. The existence, whether it is physical or not physical, you use it for more than 1 year, for sure. Right? Now, if it is a tangible asset, then it is called depreciation. If it is an intangible asset, then it is called amortization. The meaning is almost the same, but the word that we call here is depreciation for tangible asset. For intangible asset, it is amortization. That's the only difference in the words that you have. Okay, right. Now, what is the other difference? In any other difference when you talk about tangible and intangible is mostly here it is finite useful life. Okay, and here it can be finite or infinite useful life also. So what is this finite, infinite useful life? Let us discuss this. Okay. Yeah. Now, when you have purchased a building, you can say that this building can be used for 10 years. can be used for 15 years. This is called finite useful life. When you know that you are going to use this particular machinery or a furniture or a building or any intangible asset for a certain period of time, the useful life is determined, then it is called finite useful life. You know that the asset useful life is 10, 15, 20, 35, whatever it is. And in intangible asset, what happens is some cases you can say the useful life, which means I can say that suppose you have a patent, okay? This patent or a copyright or a trademark you have purchased or you have taken this patent for some 6 years, right? This is called finite useful life, wherein you can use that patent only for 6 years. Good. Now, suppose there is a patent or a copyright which you can use for lifelong. I mean, till the existence of your business, you can use that goodwill, or you can use that patent, or you can use that copyright. It is called infinite useful life, which means you don't know when you will close your business. No, till the closure of your business, if you can use that particular intangible asset, then it is called infinite life. This mostly doesn't happen for tangible asset. It happens for intangible asset, wherein infinite life means you can use it till the end of your business. Once you close down your business, that patent or copyright or trademark or goodwill, whatever you have purchased, will go in vain. Until then, you can use it. That is what is finite and infinite useful life, right? So it depends. Not all the intangible assets are having finite or infinite useful life. It depends on how you have purchased it or how you have taken the right on it. So that is the difference between tangible and intangible asset. And main thing is about depreciation and amortization. We are talking about that chapter, depreciation and amortization, right? So you have to discuss about the tangible and intangible assets. If it is a tangible asset, then it is called depreciation. If it is intangible asset, it is called amortization. So this we are clear. Now, what is a depreciation and amortization? What is a depreciation or an amortization? We call it as wear and tear, right? Usage or passage of time. You might have heard all these words: passage of time, or usage of that particular asset, or wear and tear of that asset, or obsolescence. Also, you must have heard this word obsolescence as well. Obsolescence, I mean, if that machine has become obsolete, or depletion in some value, right? So because of all these things, why are we providing the depreciation means? It is because you have purchased a machinery on 1st April, let us assume 2020. Now you have used these machinery for 5 years. Do you think, let us assume you have purchased a machinery for some 10 lakhs. Now, after 5 years, you have used this machinery. Now, if you go back to the market and say, I will sell it for 10 lakhs, do you think anyone will buy it for 10 lakhs? Yes or no? Will anyone buy it for 10 lakhs after 5 years? After using the machine for 5 years, do you think anybody will buy it for 10 lakhs? Definitely no, because you have used it. It has become a used machinery now. No, nobody will buy it for 10 lakhs for sure. That is why it is called wear and tear, because of the passage of time or usage of that particular assets, the value will come down. Yes, value is depreciated. You are right. So your value is coming down. Now, how will you show it in your books of accounts? You know that value has come down, but how will you show it? Now, when you're recording in your books of accounts, I have recorded it at cost of 10 lakhs. After 5 years also, in my books of accounts, if I'm showing 10 lakhs only, then it is not a right representation. The asset is not correctly represented, because if you're going to the market, this is only giving me 2 lakhs. Then how do you think it is a right representation, or right way of showing it in your books of accounts? It is not correct, right? Because it is depreciating. Your books of accounts also should depreciate the value in your books, correct? How will you depreciate it? There are different ways of calculating depreciation, but again, there are three main important factors. Three important factors you have to consider for depreciation. One is the estimated useful life. I just talked about useful life, infinite, definite, and all those. So, what is useful life? For how many years you are going to use this asset for? That is useful life. So, estimated useful life is one thing. Then the main thing is cost of the asset. Obviously, you have to know the cost of the asset, only then depreciation is calculated. That is one thing. And then residual value. Okay, residual value after the useful. Now, what is estimated useful life? Which means I will assume that this building will be used for 10 years. That is estimated useful life. And what is the cost of the asset? If I am going to use, if I've purchased this asset for 10 lakhs or 20 lakhs, that is the cost of the asset. And what is the residual value? Residual value means what? After the useful life, which means after 10 years. After 10 years, if I have to sell this asset or a building, what will be the value? That is what is residual value. Residual value means what? At the end of the useful life, if you have to sell this machinery or sell that particular asset, what will be the value I will sell it for? It is also called the scrap value. Yes, you are right. Scrap value or residual value are almost the same. When you are trying to sell it by the end of the useful life, what is the expected value you're going to get is nothing but the residual value or scrap value. So these are the three main important things you will have to consider, or important factors you will have to consider when you're calculating the depreciation, right? Now, when, when will you start depreciating? When will you start providing the depreciation? Depreciation should be started, or depreciation should be provided when the asset is available for use. What is the word? Available for use. Now, this word is very important. Available for use, which means what? Sometimes, though the asset is available, which means the construction is done, the building's construction is done, it is ready for usage, but you did not use it. You wanted to use it from it was ready by the end of March, but you didn't want to use it. You want to use it after 1 or 2 months, right? So actual usage is when? Actual usage is from May, let us assume, okay? But it is available for usage from March. So when will you start providing depreciation? From March itself. You will not consider when did you actually use that machinery or asset. When it is available for use, you can start providing depreciation on it. This is told by the Companies Act. So Companies Act has given this word available for use. Companies Act 2013 has told you that when the asset is available for use, start providing depreciation. Okay. Also, the standard says the same thing. Now, one more thing that is told by the Companies Act 2013 is you will have to start providing depreciation component wise. Okay. Component wise मतलब क्या है? मतलब suppose you have an aircraft. This is the best example for component wise providing the aircraft. Now aircraft will have very major components involved in it. Okay, it will have these interiors, correct? It will have these engines, then it will have the airframes, other so many other things which are like major part. Now what happens is these interiors will have a useful life of 10 years. These will have some 5 years, or these will have some 8 years. So each of the component, aircraft is such a big thing, and very components involved in it are having different useful life, right? Now in this case, the standard, or the Companies Act says that you have to start providing depreciation for all three of them separately, because each one of them is having different useful life. And also there's one more thing that you have to see: the cost. Okay, the cost of each component, if they are significant enough, significant, which means for changing the interiors, the aircraft is costing you 1 crore. Okay, the interiors only will cost you some 20 lakhs. Do you think this is a significant amount? Yes or no? When the total aircraft is 1 crore, and to change the interiors it is costing you 20 lakhs, do you think this is a significant amount or insignificant? Yes, it is significant amount, right? Now, the engine, if it has to be replaced, it will cost you 50 lakhs. Is this significant amount? Definitely yes. And all the airframes and all will cost you some 10 lakhs. This is also significant amount, right? So when the amount, the components are very having a cost of very significant amount. And their useful life is also different. Then you will start providing depreciation also separately, which means the depreciation for this will be 20 lakhs by 10 years. For this, it will be 50 lakhs by 5 years. And for this, it will be 10 lakhs by 8 years. So depreciation also will be provided separately for all three components. This is what is told by the Companies Act. So when there are significant components involved in a particular asset, those components have to be provided depreciation also separately, provided with two conditions. What is the first condition? That useful life have to be different and the amount also should be significant enough, right? What is insignificant? Now, for an aircraft costing you 1 crore, there is a component, let us assume some component, which is some 10,000. Do you think for this I will have to provide depreciation separately? Not needed. That is what is significant. When the cost is significant only, provide depreciation separately. When the cost is insignificant, don't provide depreciation separately. Treat it as aircraft only, and aircraft singly you will provide depreciation. And all these three components separately you will provide depreciation. Am I clear? What is this component basis depreciation? How depreciation is provided for different components separately if they're significant and having different useful life. Two things are mandated. Just give me a thumbs up if you're clear until here. Are you all clear? Okay. So we have seen the difference between tangible and intangible, and we have seen when depreciation should be started and what are the three main factors for calculating the depreciation. And also we have seen how component wise depreciation is done. Now let us also see what are the objectives. What are the objectives of depreciation? There are four main objectives of this depreciation, right? Why are we providing depreciation? How to provide depreciation, how to calculate, we'll see it in the end. We'll see after this. But generally, what are the main objectives of providing this depreciation? The first main objective is to correct income measurement. Okay. And the second one is true position. You to know the true position and also to funds for replacement and the last one is ascertainment of accurate cost of goods sold. Okay, for production when you're doing the production. So let's see one by one. Alright, don't go to provision for depreciation right now. Just wait now. Let us go one by one. Don't be in so hurry. Okay. Now, this correct income measurement means what? Now, when you start providing for depreciation, your income statement, it is correctly measured. How can we say that? Depreciation is a non-cash expenditure. You should remember this in mind. Why is it called a non-cash expenditure? It is because when you provide depreciation, do you think any cash is going out of your organization? No cash will go out. You will just provide depreciation as an expenditure into your P&L statement. It is part of your P&L statement as an expense. That's it. Depreciation. Are you paying this amount to anyone? Are you actually paying this amount to anyone? No. That is why it is a non-cash expenditure. Right? Now, this non-cash expenditure is shown in your P&L statement as part of your expenditure. It is almost like a matching concept. You know what is a matching concept? You have to match your income and expenses, right? Now, when I have purchased an asset for 10 lakhs, I have to match this also with my expenditure, right? So if I'm using it for 10 years, I will match this into my expenditure by providing 1 lakh every year into my P&L statement. This is what is matching concept. So one way you are recording it in your cost as an asset. The other way, you will record it as an expenditure in the form of depreciation. This is almost like a matching concept wherein you're trying to see how your income is measured correctly. Only if this expenditure is put in, your income is also measured properly. And true position. What is true position? It means you will know that I told you also before, you have purchased the asset for 10 lakhs. After 5 years, you came to know that the value is only 2 lakh. Now, can you still record 10 lakhs in your books of accounts? No, right? It is not a true position. If you go to the market, nobody is paying you 10 lakhs, then how can you show 10 lakhs in your books of accounts? It can't be shown. You have to show 2 lakhs only, or whatever is the actual value, right? How will you show it? Only if you provide depreciation, your value will come down to 2 lakhs. That is why providing depreciation is more important, right? That's one thing. And what is the other reason? Funds for replacement. Funds for replacement means now this asset, I know that I'll use it for 10 years. Now what happened after 10 years? I have to sell this asset. After 10 years, I have to sell this asset and buy a new one. Buy a new one, correct? Now, for buying a new one, again, you will need money. You will need money to buy a new one. How will you get this money? For replacing the machinery, you will need money. So this depreciation will, keep reminding you that you are providing 1 lakh depreciation means after the useful life of the asset, you will have to, also pay a replacement amount and buy a new one. So keep that in mind. That is why we are showing it in our expenditure, and, doing it on a prudence concept, prudence basis, that yes, I have an expenditure which is going to come up in future. Because I have to replace this machinery, I start providing some depreciation, or I start showing up some expenditure, and keep myself reminded that I will have to replace my machinery at the end of the useful life. So that is one objective also of why we provide depreciation. And the ascertainment of cost of goods sold. This is because cost of goods sold means what? When you are doing in the actual production cost, you're doing the production cost, right? You're calculating the production cost. In this, you start providing depreciation. Why are we providing depreciation here? It is because you're using that asset, no? You are using that asset. Provision for right? I don't know why so many are asking about provision for depreciation. Don't worry. You're still in the introduction part. I didn't go too much deep into there. So don't worry about all those things, okay? Right. So in this production, I didn't write provision also anywhere. I don't know why people are asking it. I'll discuss that. Don't worry. Okay. Now, when I'm providing this production cost, I also provide depreciation. If you remember, trading account may also take depreciation if it is relating to the asset that is used in your production, right? Which means my asset, I have purchased this machinery to use it in my production. The depreciation is also a part of my cost of goods sold only. That is why this is one more important factor, or one more important thing why we are providing depreciation. You're using that asset, so depreciation on that is an expenditure for you which have to be included while calculating the gross profit, right? So these are few objectives why we will have to provide depreciation. Now, how do you calculate depreciation? How do you calculate depreciation? Very simple. Very simple depreciation. How do you calculate? Depreciable amount divided by useful. What is depreciable amount? What is depreciable amount? Depreciable amount is nothing but cost of the asset minus residual. Right? I told you also these are the three factors. One is the useful life, cost of asset, and residual value. So these three are main things for calculating depreciation. Okay. Yes, Sarla.
About this depreciation, as we
Hmm?
call it, there are expenses or a loss. There are a lot of differences between loss and expenses are there. Is it
It is
expenses
an
or
expenditure. It is a non-cash expenditure. Yes.
it's not a
It is
loss?
a non-cash. It is not a loss. It is not a loss. I mean, loss in the sense your value is depreciating. So you have to show it in your books of accounts in some way. So you are showing it in the form of non-cash expenditure in your P&L statement or your account. It depends on how the asset is used.
Thank you, ma'am.
Okay. these are the three factors we are using for calculating the depreciation, right? Yes. Now, when I say cost, what is included in cost? Do you remember? Do you remember this cost when we were discussing inventory? I told you few things, few inclusions and exclusions in cost. Anyone who can tell me this? I'll just start so that you remember. Do you remember this purchase price? Can you continue this? After this, what comes in the cost? Okay, cost of conversion, other costs, admin expenses, right? Very good. Okay. Installation charges, yes. Okay, okay. Transportation cost. Okay, this word is correct. All expenses added to put the asset into working condition. So, Nidhi, you're exactly right. This is the word I also used when I was talking about what is cost. That's correct, right? Any installation charges and all those things, right? And if you forgot this, non-refundable taxes and duties. I told you this also, no? This word also I used. This you forgot. Freight, yes, freight also. And also I told you you will have to exclude what? Rebates and trade discount. Remember this? This also we discussed when we were doing the inventories chapter. Same thing will follow. In cost, it's almost the same. And if it is conversion, then I told you labor, raw material, all other expenses. That I told you. And I also told you other cost may admin and interest cost will come, but with an exception or with a condition that if has to be used for bringing the asset to the current location. Only for bringing the asset to the current location, if you have to incur some expenditure, or if you have to use that asset, you need to incur some expenditure, only that will be included. And I also used the word called attributable cost. So mainly it is the same. It is directly attributable cost only will be included in the cost of the asset, right? And one additional thing I will tell you here, which is again a new thing for you, cost of dismantling. This is one new thing which we didn't discuss there. Cost of dismantling, because it was not part of that, I didn't discuss. Or removing or restoring also. Restoring the asset after the useful life. Now, this let us discuss this point. This is something important because others, I'm discussing in detail, but this is something which is new to you. What is cost of dismantling or removing? Suppose there is a mining location. Okay, you have purchased it, and you have a right to use it for 10 years. Okay, for 10 years, the government told you that you will have to restore the entire mining site into as it is, how the government has given to you, and then once it is restored and brought back to the same condition, you can give it back to the government. Or you have a machinery, okay, that machinery is installed into your godown. After that machinery is used, you will have to dismantle it, because if it is a huge machinery, dismantling cost also will be huge, right? Such kind of dismantling or restoring expenditure also will be added to the cost of the asset. That is what is cost of dismantling or removing or restoring the asset, right? So what is included in the cost of the asset I discussed. And what is residual value? We all know. What is useful life? We all know. What is residual value? It is nothing but the scrap value, or the value that you are going to receive after our useful life. If you have to sell that particular asset, what is the value you will receive? Okay. I don't know. Many are confused with this point. This correct income statement and funds for replacement are different. Okay, correct income statement means like matching concept. You will have to try, you're trying to do the matching concept here. But in funds for replacement, what we are trying to do, why are we providing depreciation is to have an idea that once this useful life is done, you will have to replace it with a new machine. So you have an idea that some funds have to be kept aside, or some funds have to be used later for buying a new one, for replacing a new one. So that is why you start providing depreciation. On objective of depreciation, it is not that you are picking it from here. It is like the objective of why we are providing depreciation is one, to match your income and expense. The other one is to show the true position of your asset value. And again, it is an idea that it is going to be a fund, or it has to be replaced later. So you start creating funds for it, right? And also for ascertaining this cost of goods sold value. I hope I'm clear, Reshma. And also a red point I will mention: no admin or general overheads. General overheads and all will not be considered. This we have discussed before also. Admin, which is like in general, cannot be considered. If that admin expenditure is needed for you for mandatory to bring that asset to your location, yes. Otherwise, no. Okay. Yeah. Now, methods of depreciation. How do you provide for depreciation? Basic two methods. One is straight line depreciation, and the other one is written down value. Okay. Or this is also called diminishing So these are the two basic methods we have for providing depreciation. Straight line means what? You will have to provide for depreciation. This is like constant. This is like a constant charge, which means what? If the depreciation is 1 lakh, it will be 1 lakh for every year until the useful life. But this is not a constant charge. This is a decreasing charge, which means today if you're providing 1 lakh depreciation, next year it might be 80,000, or next year it will be 70,000. So that's the difference between what is diminishing value and straight line method, which means if you're providing depreciation, if that suppose depreciation is 1 lakh here, this 1 lakh will be for all the 10 years. But here, if the depreciation for the first year is 1 lakh, second year might be 90,000. Okay. Third year will be 80,000 or 82,000 or 72,000 or 60,000. It will go on. Fourth year, fifth year, and sixth year, it will go on. This is why it is called decreasing charge. And this is a constant charge. Okay. Let us also see the formula. It's the same. Cost of the asset minus the scrap value, or it is also called residual value, divided by useful life. Right? And here it is a bit different formula, but you just know the formula, but how to do it we will see. Don't worry about that. Cost of the asset. This whole power have to be 1 minus n. And what is n? Useful. Okay, that's why I told don't worry about this formula. We will, when you are doing the problem, it will be easy only. Don't worry too much. Okay, this is the formula of how we calculate depreciation in two different methods. Now, let us also see accounting entries. Journal entries, right? Depreciation account will be debited, and what is credited to accumulated depreciation account, or you can also write provision for depreciation. Okay. Then this is the first entry. And the second entry is P&L account, profit or loss debit to depreciation. This is one way of providing journal entries. So what happened here? Firstly, you have provided depreciation and you have transferred it to P&L statement. That is what that happened here, right? Useful life and estimated life, same, yes. Useful life or estimated life are same, yes. Now, here comes this provision for depreciation, right, or accumulated depreciation. What is happening is either you can do it to an accumulated depreciation account or provision for depreciation or account, or there is other way also. I will show you that as well, that entry as well. This first entry can be depreciation account debit to asset account. Debit to depreciation. There are two ways of doing it. I'm showing both of them together. So there are two ways of doing it. Either you transfer the depreciation to the asset account, and that depreciation is transferred to P&L statement. Okay, or you create a additional account. You are creating one more new account, which is accumulated depreciation account or provision for depreciation account as a new account, and then you transfer that depreciation there and also to your P&L statement. Anything can be done. Anything is okay, but mostly people follow this easier method to transfer the depreciation to the asset and then P&L statement also. Two effects have to be given to for the depreciation, right? One you transfer to the asset, and the other one is transferred to the depreciation. Finally, what is happening if this depreciation and this depreciation is getting cancelled, debit and credit, you are left with this. So P&L and asset are only affected because depreciation is getting cancelled, right? So that is one way of doing it. Or you can also create one more account, which is accumulated depreciation account or provision for depreciation account. Provision for depreciation is just an account which is created to see what is the depreciation we will have for all the years. Okay. Now, depreciation account will be closed every year, no? But accumulated depreciation account or provision for depreciation is like a cumulative balance account, which means depreciation for the first year, second year, third year, fourth year, all together will be there in this accumulated depreciation account or this one. This is like a cumulative balance account, wherein you will know, once you look at this account, you will know that for 8 years I have provided this much depreciation. But in this method, you can't know that because you have never accumulated the depreciation here. You are directly transferring it to the asset. This is the balance that will be there. So the presentation difference only matters here. Now what happens here? Asset is shown at cost minus depreciation in this way. If you're following this method, asset is always shown at cost, and accumulated depreciation is one account which will be showing the cumulative depreciation for all years. This is the only difference between the presentations. Otherwise, anyway, it will go to P&L statement only. It has to go to P&L statement, right? Any questions in this journal entries? If not, we'll move to a problem. I'll just pause for 1 or 2 minutes. Any questions till here in the journal entries? Or shall we move on to a problem? Got you, Reshma. Please don't worry. I will. Okay. Now, let us assume. I'm just taking an example. I am assuming that asset is purchased for 10 lakhs. Okay. Where will you show it? It is a rough account, so don't worry about the format and all. In a format, we'll do the illustrations just for your understanding. I'm giving you a rough example, so please don't worry about the format. So when you have purchased the asset, you will record it on the debit side. Yes or no? Agreed, everyone? When you're purchasing the asset, it should be shown on the debit side. Clear? Now, when you're providing depreciation, where will you show? You will have to show it on the credit side, depreciation of 1 lakh. Yes or no? This is what we generally do, right? Now, after 1 year, what is the balance you have in your account? 9 lakhs. Yes, 9 lakhs is the balance you have in your account. So, when you're showing your balance sheet, what is happening in your balance sheet? On the asset side, you have building, which is having a value of 9 lakhs. Okay, this is the presentation. Assets you have building, which is 9 lakhs. Everyone agree to this point? Where are you all? Yes, yes. So this is clear, right? What is happening here? You are purchasing an asset, you write it on debit side. After 1 year, when you have to provide depreciation, you write it on the credit side, and then balancing figure will be 9 lakhs, which you are showing on the balance sheet. Correct? Now, this is what is this method. This one. This method, the second method, whatever I've shown, depreciation account is going to the asset account, and P&L account also the depreciation is going, and the balancing figure is coming from your asset account itself. This is one way of presenting. Now let's see the other way of presenting this. I have asset. Okay, I've purchased building. To bank will come just 10 lakhs. This will be there like this only. Now, what will happen to accumulated depreciation is depreciation is debited 1 lakh, credited 1 lakh here in the accumulated depreciation account. Okay. Now, I will close this account. I will close this account also, accumulated depreciation account. Now, how will you present this in your balance sheet? That is again a question, no? Let us see that balance sheet. Balance sheet mein, you have assets. You will write building cost 10 lakhs minus accumulated depreciation 1 lakh, final figure 9. Now this is clear. Now this is clear. Asset account is having still balance of 10 lakhs only. Okay. Here you are having a balance of 1 lakh. So both the accounts have to be shown in your balance sheet and net figure is shown. Finally, the answer is same only, no? In this method, in the first method, here the asset building value is 9 lakh. Here also the building value is 9 lakh only, but the presentation is making the difference. You're showing the cost of the building and accumulated depreciation separately, or you're showing a net figure separately. That is what matters. So this is what I have done here. You're using accumulated depreciation account or provision for depreciation account, then this will be the way you have to present in your balance sheet. If you are directly taking it to the asset account, this will be the presentation. Am I clear? Now am I clear? Asset or building, whatever it might be, I just took an example. Don't worry about that. Are we clear? Any questions? Yes, Sarala?
In case of second method, what is shown now, that is asset is taken at 10 lakhs on asset side. If you take like that is depreciation, accumulated or accommodated depreciation on liability side, so that it will be carried forward to the next year also. The building will be at the real value, at purchase cost only, no ma'am.
Building is recorded at purchase cost only in this method. In this method, what happens is this will continue. This building will be continuing. Next year also the balance will be 10 lakhs only. Okay. Next year also the balance will be 10 lakhs after 1 year. First year, second year also balance will be 10 lakhs. But here in accumulated depreciation, what happens? First year it is 1 lakh. Second year depreciation, you must have provided 1 lakh. then your balance is 2 lakhs now. Okay. Third year, you again provided depreciation of 1 lakh. Now the balance is 3 lakhs. So it will go on. Your accumulated depreciation will start accumulating depreciations for all the years, and you keep accumulating them. But the asset will remain at cost only. In this method, asset is always shown at cost and depreciation is accumulated in the form of this provision for depreciation account or accumulated depreciation account. Clear? And it should be shown as a net figure to your asset only. It can't be shown as a liability because you don't have to pay it to anyone. It is shown as a net figure only to your asset account. Clear?
Okay. Thank you.
No. At least let us do a few problems. Yeah. Look at this question, first question. Illustration 1. So what is given in this question? Jane Bros acquired a machine on 1st July 2021 at a cost of 14 lakhs, right? They have purchased it for 14 lakhs and they have spent 1 lakh on its installation. Should we add this to the cost of the asset? Yes or no? Should we add it to the cost of the asset? Is installation part of your asset cost? Yes or no? Yes. Okay. Everybody is saying yes. Anyone who says no? Okay, great. Very good. Very good. Now you all are clear then. Yes. Next one. The firm writes off depreciation at 10% per annum of the original cost every year. The books are closed on 31st December every year. So what is the year end date? 31st December. They're asking you to show the machinery account and depreciation account for the year 2021 and 2022. Correct? Okay. For both the years, they are asking you to show the machinery account and depreciation account, both of them. Now, this is a format of writing a ledger. We'll have to write date, particulars, and then amount in rupees. Debit side and credit side. Both the accounts have, both the sides have to be written, right? Done? Yeah. So what happened? When did it happen? On 1st July 2021. Right? This happened on 1st July 2021. What happened? You purchased a machinery. It will come on the debit side for sure to bank account. What will be the value? What will be the value? It will be 14 lakhs. Right? Next, on the same day, you also paid for installation to bank account. This is clear. So 14 lakhs is paid to the supplier from whom you have purchased machinery and 1 lakh you have paid for installation. So I'm showing both of them separately. 14 lakhs and 1 lakhs. Together, the cost of the asset is 15 lakhs. They didn't mention which method. We are going to do both the methods. Don't worry. Okay. Yeah. Next one. What is the year-end date here? Year-end date is 31st December. So on 31st December, what happens? You will have to provide for depreciation. by depreciation account. But what is the value? We don't know what is the value. You have to calculate it. Right? Let's go to the working note. I am doing straight line method first. I will also do the WDV. Straight line method. What is the depreciation percentage given to you? They told you it is 10% per annum, right? So for the year 2021, what is the date? Closing date? 31st December 2021. Depreciation will be how much? Depreciation will be equal to 15 lakhs is the cost of the asset. 15 lakhs into 10%. And one more thing you have to take is 6 by 12. Why am I taking 6 by 12? It is because the asset was not purchased on the beginning of the year. It was purchased on 1st July. So you have used the asset only for 6 months in 2021. So I am providing depreciation only for 6 months, right? So the depreciation is how much here? How much is the depreciation? 75,000, okay. Okay, 75,000, fine. So depreciation is 75,000 here. Done. Okay. Now let me close this account. Balance will be on the debit side or credit side. Debit side, the balancing figure will come, or credit side. Balancing figure on the debit side or credit side. Okay, credit. What is the balancing figure? Okay, 14,25,000. Did everyone get this? 14,25,000. I think almost everybody gave the same answer. Okay. Total is 15 lakhs. Done. So 2021 is done. 2021, you have purchased the machinery, you provided the depreciation, and then you closed the account by taking the balancing figure. Reshma, what is your query? What is your query, Reshma? You first do the machinery account and you can show the working note below. You can show the working note below. Okay. You can draw the account first and then you can show the working note later. Okay. Now, what will happen to this balancing figure? Okay, let us also do the depreciation account. They asked us the depreciation account also. No? Depreciation account. Debit side, credit side, date, particulars, amount in rupees, date, particulars, amount in rupees. Yes. So on the depreciation account, you will have it on the debit side or credit side. You'll have on the debit side or credit side. Debit side, okay, debit side. What will we write on the debit side? To machinery account, right? To machinery account. Why? Because the journal entry here is depreciation account debit to machinery account. So in the depreciation account, it will be on the debit side. And in the machinery account, you have written it on the credit side. Right? We are done. Now, what is the value? 75,000. This will be on 31st December 2021. Now, by balance carried down, this will be on 31st. I'm so sorry, it is not balance carried down. It is 31st December 2021. It will be by profit or loss account. 75,000. No balancing figure. We have to close this depreciation account. P&L account. Yes, yes. We are closing this account by sending it to P&L account. Okay. So first year is done. They asked for 2022 also. So let us continue for 2022 also. 1st January 2022 to balance brought down will be how much? 14 lakh 25,000. 14 lakh 25,000 is the balance brought down. Do we have any new asset purchased in this 2022? No, nothing is given. There is no purchases, or there is no new installation or some other expenditure. Nothing is there. They asked you to provide depreciation only. So the next one will be on 31st December 2022 by depreciation. Okay. By depreciation account. What is the depreciation amount? We don't know. Let us calculate that. So 31st December 2022, what is the depreciation? Depreciation will be 15 lakhs into 10%. What is the answer? This 1,50,000. Okay. So here it is 1,50,000. Now let us close this account also. Close this account. Balancing figure will come on which side? Debit side or credit side? Credit side. So by balance carried down. How much is the carried down balance? Okay, 12 lakh 75,000. The total is 14 lakh 25,000. Lakh 25,000. Are we done? Go to the depreciation account. On 31st December 2022 to machinery account will be 1,50,000. Again on the same day, 31st December 2022 by P&L account 1,50,000. So we are done, right? So the machinery account is done and depreciation account is also done. Asset account is having a balancing figure of 12,75,000 and depreciation account is closed by transferring the balance to P&L statement. Are we clear with this? Anyone? Any questions still here? Any questions? Okay. Now, working note, one more working note I'm doing. Diminishing balance method. According to this method, 31st December 2021, what will be the depreciation? It will be mostly the first year depreciation will remain same in any method. It will be 6/12 only. Okay, so depreciation for 31st December 2021 is 75,000 only. It will not change, correct? Now, 31st December 2022, the depreciation will be how much? Depreciation should be calculated on the diminishing value, right? What is the diminishing value here? Diminishing value will be equal to 15 lakhs, which is the cost of the asset, minus first year's depreciation 75,000. So which is nothing but 14 lakh 25,000. Correct? This is diminishing value. Now depreciation will be equal to 14 lakh 25,000 into 10%. Agreed everyone? Is this clear? So what will be the depreciation? 1,42,500. The difference in the depreciation is only in the second year, second and third year, and on so on. The first year mostly depreciation will remain same in any method, right? So this is diminishing balance method and this is straight line method. I have done just the working note for depreciation. Now the homework for you is to do this machinery account and depreciation account using that method. So what will change here? What will change? This completely will remain same. All this will remain same. Only this figure will change, then balancing figure will change. And here also, first year it will remain same. This figures will change. That's it. You just have to rewrite this account using the diminishing value method. I hope you all will do it. Rest all it is same only. Balancing figures will change accordingly. Any questions till here? So if you look at this, the first question, illustration 1 we have done is done using the straight line method. Illustration 2 is done using the reducing balance method or diminishing value method. So this you're going to do. Am I clear? Yes, Sandhya?
Ma'am,
Yes,
uh,
yes.
ma'am, and for asset account we have balance brought down and balance carried down. Depreciation is it's a nominal account, right? Why don't we
Hmm.
have any carried down like that?
Depreciation is an expenditure account, no? So it has to be closed by transferring the balance to P&L statement. An asset account is not a you know nominal account. No, it is not an
It's
expenditure account.
yes, ma'am.
Asset account will always have a balance. This balance where will you show in your balance sheet? But depreciation is an expenditure account, so the balance has to be transferred to P&L. You close down all the expenditure and income accounts. Asset and liability accounts only will have balancing figure. Yes or no?
Yes, ma'am. Understood, ma'am.
Okay. Anyone else? I know time is up, but any questions I can take up. No questions. I'll close then. Karthik, you want to ask something? Yes, unmute yourself. Because you have written
Yes,
something, it
ma'am.
has gone up. Yes.
Ma'am, I have to confirm that if we made depreciation account, his balance will post to P and L account. And if we made provision for depreciation account, we post to that liability account. Liability matlab in balance sheet.
If you are creating provision for depreciation account, it is like a liability account, but you don't show it under liabilities. You will show it as a net figure. I've shown the presentation here. No, where is it?
Yes,
Yeah.
yes, ma'am. Okay, ma'am,
If you see
understand.
here, it is a liability account only. It will have credit balance, but it will be shown as a net figure to your asset. I mean, it will be removed as a balance from your asset, and net figure of the asset will be shown.
Okay, ma'am.
Okay.
Okay.
Anything else,
Okay, ma'am.
Karthik?
No, ma'am. ठीक है, ma'am.
Okay.
Thank you, ma'am.
Some people who have written, I don't know if I mean, it has gone up. So if I missed any of your queries, please, someone wants to ask, you can. Otherwise, I'll close. Any other questions? What second step, Reshma? I mean, what is your question exactly? Unmute yourself, Reshma, and ask. No? Reshma, you can unmute yourself and ask because I'm not getting what you're asking. Manish, can we close?
Yeah, ma'am.
Yeah. I mean, we still have inventories, depreciation, one more class. So depreciation and amortization will continue in the next class. I think it's tomorrow only. So we'll continue tomorrow.
Okay.
Yeah. Thank you. Thank you,
Thank you,
students.
ma'am.